Mr. Pradip Shah joins us now. We have him on the show after a real long gap. So, Mr. Shah, good morning. Thank you for joining us. What is your view on the market? Do you think markets are now due for a time-wise and a price-wise correction, given that this market is suddenly running out of positive triggers?
Well, there are still some positive triggers left, and that depends on the government, not as much on the passive economy as such. But clearly, the market will have to see catch-up of profits, because it's already run up in anticipation of profits or growth, and in terms of growth going forward. So we are talking of 9.3% growth for FY22. From a 7.5% negative for 7.3% negative for FY21. So that is being factored in. Don't forget, we had a great monsoon last year, and that food grain output was 303 million tons, horticultural output was 327 million tons. There's a lot of agricultural income reflected, for instance, in tractors demand in February, 18% growth, and still passenger cars, there's still some pent-up demand growing at 10%. But the pent-up demand story is pretty much over, I think, because you can see it in consumer products, and for instance, two-wheelers, where it's down by 16%. So what will sustain it is the anticipation of profit growth and the economy growing, and we must grow faster than the world. The world is doing well. Don't forget, the United States, with an 8.5% stimulus, $1.9 trillion stimulus, and $1,400 check going, is expected to grow this year at 6.5%. The OECD said so. Yesterday, the Fed confirmed it. And of course, the OECD countries are expected to grow at 6.2%. The European Union is supposed to grow at 3.9%. And of course, the world economy will grow at 5.6%. So there's a momentum just now. So if we can grow faster, we will attract money. It is money, it is growth that attracts money from outside. If that happens, our prices will sustain. And if we continue with the growth, then profits will catch up also. So that is where I am very optimistic that it's not going to be a correction. There is going to be inflation. The Fed confirmed it. There's going to be interest rate increases going forward. But at least for the foreseeable future, if we do not have a major problem with our pandemic, we will be in much better shape. And I think there are 2-3 things that government has to do for that. One is, as Mr. Modi said, increase the vaccination centers. Just open it up for private sector to participate and give doses, so that and people don't have to fill forms. In the United States, they're giving a little card which is handwritten, so people who are literate, illiterate, who don't have any access to internet can still go and get a shot. And then, of course, a fiscal, monetary, and supply side management together. So I think if Mr. Modi were to consider putting up a triumvirate, empowered triumvirate of these 3 sectors to oversee inflation and food inflation, I'm talking of essentially edible oils, food grains, vegetables, etc., that those should be controlled, then it hurts us less. And third, of course, reduce bureaucracy, and then we would see growth. China grew at 13% per year for several years on end.
Okay, so let's put that into context. Should one stay invested in stocks, or it's time to raise 25-30% cash? Is it time to protect and lock gains, or this is just a blip, and 3 months from now, a year from now, this will turn out to be one of the best spring buying chances?
So, if we are a high growth economy, we will continue to grow. There will be temporary ups and downs in the market, sentiment changes, some action by government, bureaucracy, etc. will cause some dips and so on. But the secular trend is up for the Indian markets because of this growth that we see, and it will be superior growth as compared to the Western world, and the developing world. So given that, it's very difficult to pull out of equity markets, and where do you invest it in debt instruments where you have credit risk as well as interest rate risk, as well as, of course, inflation risk. You get your income gets eaten up by inflation. So you can recycle from very high multiple stocks and go into relatively lesser price stock, lower price stocks, for instance, where multiples are lower. There may be slight adjustment required, for instance, where as inflation picks up, there will be some commodities which will do well. You can pick up those. and again, they are still relatively better priced than some of the other. You see industrial companies going at multiples of 50 in the current market. Clearly, there is an over exuberance of optimism on some of these companies. So capturing those gains, but staying out of the market is a big challenge to stay out of the market when you have anticipation of higher inflation, when you have alternatives which are actually not as attractive.
Sure. Pradip, how is it that you're actually, monitoring and would recommend investors maneuver themselves when it comes to financials? Because while NBFCs have had a great recovery from the March lows, I can't say the same about banks. They've still got the moratorium issue looming or hanging around their necks still pretty much. And a lot of concerns about, purely the high beta and over-ownership of the sector that it brings with it.
Yes, so banks, of course, in banks, we have banks and banks. We have seen superlative performance from a bank like HDFC. We have seen very good performance from ICICI and so on. So clearly, and Kotak, look at Kotak, look at the share price, for instance, price to book and so on, whatever you look at. The banks, not all are in the same boat. Some of the public sector banks will also do well. Look at State Bank of India, the technology that they've adopted, going for that YONO app and hopefully making it a super app. I think there are good banks even in the public sector. But of course, those banks which are handicapped because of the organization, because of the systems, because of the technologies, they're going to be affected. And of course, there's going to be a consequence of the legacy lending that these banks have done. Most of these banks will be able to absorb that shock going forward when the moratorium unveils the problems in lending and also in microfinance, which, because it became a holy grail, it was like everyone was running for it. You are going to see problems, and you cannot have concentration. The secret in lending is, of course, diversification. So when you have small loans, it's very good, but diversify by geography, diversify by sectors, in that it's not all professionals or self-employed people or so on. So I think a universal bank, to my mind, is a much better choice, which has distributed assets in different classes of lending and which has good systems and processes. Of course, management ultimately is a driver of all this. So you have to look at how the management has demonstrated its competence. But this is not a write-off. Banks are not a write-off. It's NBFCs which I would worry about, that some have got excessive zeal in their pricing and some are trashed, and some are too optimistic with their lending businesses and may find that they'll learn as they go along. That's concentration into, say, just microfinance or something is not a great idea.
Sure. On the subject of inflation worries, Pradip, and given that across commodities you are actually seeing a price hike coming in, be it steel, be it agri-commodities, even the paper industry, packaging, costs are going up across the board, and of course the dominant one being fuel. Do you think that's going to bear heavy when it comes to earnings? Because, the choice is either between volumes or margins, and at some point, the profitability will be eaten up, at least for the pure play staples, at least.
You're absolutely right. I think all companies will see this cost push factor reflected in the next year. And so unless they grow faster, unless they come out with newer products which can command better value and therefore better margins, you are going to see problems with profitability. Their profits will not be maintained. Will not be maintained on the same level as last year's. As I said, unless they have growth and they make up in absolute numbers, but certainly margins are going to be under pressure for almost all companies because of the cost push. I think on inflation side, government must do something, make the economy much more elastic in supply. That means reduce the bureaucracy, reduce the hindrances that exist in our economy. The permissions Raj and the license Raj and the hassle Raj that exists in the country. Reduce that so that supply can come. If there's inflation, there'll be more supply coming in quickly. Number two, I think government must recognize that only fighting inflation with monetary policy is not the answer. Fiscal policy is required. So, for instance, giving protection by having very high tariffs. Yes, it helps industry grow, but it doesn't necessarily counter inflation. So you must allow this tariff calibration to be a counter to inflation, not just in food products, but also in industrial products. And that, I think, requires a little bit of commercial acumen in the government. And not always are regulators as commercially inclined. They are doing their job. They want to see this and that. Only in their limited perspective, they forget the big picture that Mr. Modi talks about: ease of doing business, ease of living, and high growth for the economy. That is forgotten in their narrow perspective, whether it's the Revenue Department or the Ministry of Corporate Affairs. Look at how onerously they put new conditions on whether it's independent directors or it's on CSR from a comply and explain or comply or explain. It's now become compulsory with prescriptive loading of CSR spend, and of course detailed reporting, which means how much time and effort is being spent. Look at your KYC requirements. Every bank has to comply with KYC paperwork, the number of filings that they have to do. It is adding to intermediation costs. Why do you need all that kind of KYC? Mr. Modi said, why don't you have automatic renewal of KYC? Why don't you have long KYC for a longer period rather than every year and every 2 years you have to renew it? I mean, these are things which our Indian bureaucracy is unfortunately looking at their narrow perspective and forgetting the big picture.
Pradip, what's the outlook when it comes to the entire tech sector as well? Apart from the traditional theme within the IT companies, it's also transcending across industries, be it financial services, entertainment. There's a lot of disruption that we're seeing. How does one really capitalize on this space?
So, of course, the easiest way is, of course, through the, as you said, the tech companies which have got their act together. They are providing complete solutions for their customers, not just providing body shopping or application development services only. They are also developing proprietary technologies and offering total complete solutions in cloud-based and so on, so as a managed service and so on. So I think most of our tech companies are doing are very well and will do very well. On the other side, biotechnology and so on, we are just seeing the beginnings of companies wanting to acquire intellectual property on whether molecules or hardware, for instance. And we have a lot of entrepreneurship in the country. We are seeing, I'm associated with some startup venture funds and so on. You see that it's so much energy, so much of ideas. What they need is direction, a little bit of support, and that can lead to more technology participation. But of course, it is all in the private equity or venture capital domain. In the listed space, it's the pharma companies that are taking the lead in developing new molecules. And there are some which are doing a great job. Even first, our focus had been in the past to reduce costs because there was price control in pharma industry. Then the focus came on improving processing steps. A great process engineers and organic chemists and inorganic chemists brought out, increased the yields or improved output faster. But now the next phase in these pharma industries will be developing molecules and developing hardware related to software that will help the healthcare industry. And we are seeing that happen. So pharma industry is another area where I think you will see a lot more improvement in technology.
Okay, fair enough. Really diversifying and spreading across sectors. Yes. And what's the sense that you're getting when it comes to the entire infrastructure basket, as we are seeing us coming out of the throes of the COVID pandemic and things gradually picking up, execution, ordering activity, etc., improving? What's the view?
So infrastructure, of course, the need is very obvious. The demand is there. What we need to do is get our regulatory act together. Just to give you an example, the Petroleum and Natural Gas Regulatory Board came out in October with guidelines which allowed for private new entrants to come into infrastructure created by the existing entrants and taking away their customers at a discounted price of 12% return on capital employed for that infrastructure, less deposits, etc. Now, it made no sense. Why would anyone make investments in the infrastructure if somebody subsequently was to get away with a discounted access to existing customers created by those people? These regulatory in every area, by the way, it's not just this. It's Electricity Regulatory Act or the electric regulation or the financial regulations and so on. We see much too much narrow a focus by the regulators. They are looking at their perspective. Revenue, I want more revenue, so I have to do it. They forget that by having 28% GST on, for instance, cement, or 28% GST on some automobiles and so on, you're killing that industry, you're hurting that industry. You want growth. the volume of revenues that the government will collect if they have increase in volume of demand is much greater than by having a higher tariff or higher rate. And that commercial acumen in the government, I think, is not visible because each regulator is focused on his or her own area.
Pradip, just wondering because the fact of the matter is that you got to weigh in at equity as an option once the interest rate trajectory starts to move. For now, given the Fed commentary last night as well, it doesn't seem like it's going to happen in the distant future, and especially from the RBI Governor Shaktikanta Das's commentary as well, on the sidelines of the last monetary policy, it seems like the RBI is going to do whatever it takes to try and instill growth. Inflation is not a concern right now. It's purely instilling growth back into the economy, which has really gotten battered after the pandemic. But by when do you believe that the markets would begin to price in the fear of inflation if it already hasn't?
I think perhaps the trigger will come from outside. In the United States, for instance, as you saw, the Fed said that it's likely to be higher. A year down the road, we will see that so much demand, this 1.9 trillion stimulus, $1,400 checks going and so on, will create interest rate, the inflation spike, and therefore interest rates will go up. That's a very sensitive economy. India is not as sensitive on interest rates, by the way, and our monetarists think that by controlling money supply or by tightening up on interest rates, or increasing interest rates, you'll be able to control inflation. That's not really going to be the answer. So I think the trigger will come from the United States, probably, that there is evidence of inflation, interest rates will go up, the dollar will go up, therefore perhaps money will flow out from here, and then suddenly we will also be constrained to jack up interest rates in order to address the inflationary factors that we see. Now, here, as I said, the inflation that should be of worry is in food grains, in vegetables, in edible oils, etc. And for that, if there was fiscal, monetary, and supply side action taken together, not independently by the Reserve Bank, by the Ministry of Finance, or by the Ministry of Consumer Affairs or Agriculture, whatever. It should be together. They must balance out that, look, our objective is 9.3% or 10% or double-digit growth, and for the foreseeable sustainable growth. How do we control inflation so that it doesn't hurt the poor? And how do we reduce the bureaucracy so that elasticity of supply comes in to fight inflation? It's supply that can address inflation. So if that kind of approach is taken, a joint approach in fiscal, monetary, and supply side, I think we would not have to worry about inflation, but we are not there. And therefore, I think first reaction will be the monetarists will say, oh, tighten up on money supply, tighten up on interest rates. And we will see that in the next 6 months, you will see a lot of demand for that kind of thing.
What are you doing in this market? You've seen many cycles. You understand the importance of diversification. Buffett has made 85% or 90% of his wealth after he turned 60. So are you aligning your portfolio to do the same?
I personally, of course, am an equity person. I think that is the solution for anyone's retirement or for one's well-being going forward. But picking and choosing, India is a stock picker's dream country with 4,500 companies and so many hundreds of actively traded companies, and one can always find something to buy, something to sell, something to hold, and that decision is not that difficult. First and foremost the management, and then of course the industry and so on. So I think remaining in equity, but yes, capturing gains when there is irrational exuberance, when there is much too high return that you've got, because it cannot be sustained. Those kinds of multiples cannot be sustained. So you capture some of those gains and recycle that money back. You may hold it temporarily in a money market fund or so, but eventually you have to get back into equities. And clearly, there's going to be more and more supply coming in as unlisted companies go public, as new venture capital situations develop and grow into scalable companies that can go to the public market. And even today, In fact, you will see asset classes, the equities market has gone up, but real estate has not gone up. So there may be some shift possible, you can think of not as investment, but, if you have a need for an office space or a residence or an additional residence, yes, those are there. But investment in real estate makes really very little sense to me. Investment in gold makes no sense to me at all. I would remain in equity, perhaps, as I said, for temporary period, some portion parked in debt securities or money market funds, but not, again, debt, because inflation in India is going to be a reality going forward.
Point, Mr. Shah, once again. Inflation is a reality. Bond yields are at 6% plus. Do you think, apart from capital protection, debt should not be part of anyone's portfolio? I mean, if you need to protect capital, 6%, 6.5%, maybe 7% in a short duration fund, that's about it. But anybody who's looking at outsized returns or market beating returns, buying a debt instrument, whether it is in India, whether it's globally, could be a silly, and I dare not use the word stupid, but a silly idea.
No, so I think at a certain age, you cannot be largely in equities. You have to be more in debt because you need regular income and so on. So as you pointed out, if there is someone interested in growth of capital, in increasing returns on the assets one has and building up for a nest egg for the future, yes, certainly equities is the way. And debt is not. In Switzerland, in Germany, you have got negative interest rates. How does it make sense to put money in a bank? It absolutely doesn't make sense. And then you see the episodes like this green sill and so on, where in just searching for yields, they make big mistakes and have humongous problems. So I think even the junk bonds is going to be a major problem going forward in the United States. It's a continuous stimulus that government in the United States has provided that has enabled those junk bonds to stay afloat. And last year the Fed went in for fallen angels, making direct investment in securities of private sector in order to safeguard the treasury operations of the country. But that is not a solution for India. So I think you have to recognize that debt is for some people because they need incomes. Dividend yields are much lower. Remember, in a high growth company, dividend yields are 1% around, or maybe even less sometimes marginally more. It's very difficult to get dividend yields on equities. So you have to think of growth, and then at some stage you will have to put some money in fixed income in order that you get regular income. And in India, fortunately, even some of these fixed income have been providing, at least for retired people, some reasonable return in terms of absolute numbers, 7% or so, for instance, on government securities. The 10-year bond is giving 6.24% today in India. Completely safe 10-year bond is 6.24%. Subject to inflation, but you have regular income and you need that income.
All right, it's been a pleasure chatting with you, just getting in your views across sectors as well as for the markets and some important triggers that we need to watch out for, Pradip. Good to have you on board.
Thank you. Bye-bye.